Do you struggle to recognize when we have a real market structure shift, or as others call it, change of character, and when it's a liquidity grab? If yes, pay close attention. Market structure is so simple, but so many still get it wrong. And the reason for that is because traders are too focused on the lower time frames and neglecting or completely forgetting about the higher time frames. In this video, I will explain how I identify market structure on different time frames and how I put them together in order to know when we have alignment for higher probability trades. First, I will cover the different market environments. Then I will share how to define the structure most easily and show you some examples on the charts. And lastly, I will share the main things to observe in order to avoid getting trapped by fake market structure breaks. So grab pen and paper and let's get started. First, I'm going to start with the different market environments. We have three different types of market environments. The first one is a trending environment, which can be either bullish or bearish. When price creates higher highs and higher lows, we are in a bullish trend, and when price creates lower highs and lower lows, we are in a bearish trend. The second type is a ranging market, and this is an environment when price is bouncing between two levels. This type of environment usually occurs at equilibrium. So if we identify the last expansion leg from the higher time frame that we trade, we're going to notice that usually the ranging environment comes at equilibrium points. And lastly, we have the choppy market, which is again a ranging market, but much harder to read and understand. So we have a clean ranging market when we can identify and see that price is bouncing between two different levels, and we can look for opportunities within this ranging market. But sometimes price is not clean at all, and it's liquidating all possible internal structure, and it's very hard to identify where price is heading. In such kind of environments, we want to stay away. And usually it's very hard to identify that we are entering such an environment like beforehand. We start noticing that when we start hitting stop losses. So if you see that you have multiple stop losses in a row, try to zoom out and look for the overall picture on the time frame that you're trading, because this might be the reason why you're hitting stop losses if you're following your trading plan. Here's just one example. This is a weekly chart on pound dollar. We can see that from the last expansion leg on the downside, price has been ranging near the equilibrium. And if you go to DXY, if you go to Euro, you will see the same pattern occurring around equilibrium. And this applies also to lower time frames as well, not only the higher time frames. The second thing that we're going to discuss is the market structure. And the easiest way to identify the market structure is switching from the candlesticks chart to the line chart. The reason for that is because the line chart is eliminating the noise. So we don't have wicks, we just have the closure of the body of the candles. And we know that the wicks do the damage, they take the liquidity, and the bodies are telling the story. The bodies are telling what price actually wants to do. So once we switch to the line chart, we can start identifying the major swing points. And you can use different colors while you're practicing and training your eyes for those different major swing points on different time frames. So for example, for this particular example, we had the market structure shift here, and the only major swing highs and swing lows that I will mark on this chart would be this one here, this one here, this one here, and this one here. And you might ask, why aren't you marking up these ones as well? Well, the reason for that is because this structure is internal structure, it's not external structure. And we want to identify the major swing points that are creating the external structure. This is still valid for lower time frames. So you can do the same thing on different time frames. I'm just giving an example on the weekly chart, but you can do the same practice on the lower time frames as well, depending on your trading style, whether you're a swing trader, scalper, day trader. So the reason why I'm not marking up those swing highs and swing lows is because these ones are usually used as internal liquidity, and later on price continues in the same direction. If you haven't watched the video about liquidity, I will link it in the right corner, so you can check the video about internal and external liquidity. So when we're in a bullish market, price is targeting internal liquidity, sell side liquidity, in order to later on target external buy side liquidity. So I would take another color and I would mark these internal swing highs and swing lows as well. Why? Because we can identify when we have a market structure shift and look for counter trend trades while we are retracing towards discount. So these levels are still important, and they're also telling us if price is still respecting the order flow, the same direction. So the tip that I can give you, that I used at the beginning when my eyes were not trained to be able to see the clear structure, is I would take a Fibonacci and I would just check if we have made a 50% retracement. If it was not a 50% retracement, I would consider this as an internal structure. If it's less than 50%. If we had a 50% retracement, I would consider it as a legit major swing point. So once we identify the major swing points, both external and internal, we can start looking for alignment of different time frames in order to look for trading opportunities. So in this case, let's say we have a swing trader, and this swing trader has identified that we are bullish on the weekly chart. The major swing points are telling us this price is creating higher highs and higher lows. Once we started retracing lower, and I will switch to candlestick chart now. Once we started retracing lower, we've been bearish. The order flow has been bearish here. And what happened? We know that the weekly is bullish, but all other time frames are bearish. And we're here talking about the market structure, not the order flow. So once we tapped into discounted level from these major swing points, once we tapped into a discounted level, we should go on a lower time frame and look for market structure shift on these time frames. So let's say the weekly here was bullish, but everything else was bearish. Once we got this 4-hour market structure shift here, this is an early sign that we are starting the expansion on the upside. And if you go even on the daily chart, it will be the same point. Usually those points are the same on different time frames. So you can use different colors just to see which are these major points that we are looking at. And as you can see, the same market structure shift that would occur on the 4-hour chart is on the daily chart as well. So once we see that, we have two time frames aligning. So we have the weekly with the bullish structure, and now we have the daily and also the 4-hour aligning in the same direction. So once we have those two time frames aligning, and when we are bullish, we buy in discount. When we're bearish, we sell in premium. So once we have this checklist ticked, we can drop lower, and when price has retraced on this lower time frame in a discounted zone, we can drop even lower, such as 15-minute chart. So here we are on the 15-minute chart. This is the market structure break on the daily and the 4-hour chart that we had. and this is the Fibonacci on the last leg. So once price reached discount, we could mark these relative equal lows as a liquidity pool, and once we had this liquidated, we can consider this as a market structure shift, and from here look for an opportunity to go higher. And the last thing that I want to talk about is the difference between a market structure shift and liquidity grab. How to identify if we have a real market structure shift or we just have a liquidity grab. The first question that I ask myself is, did we tap into an area of interest on a higher time frame, or did we take a significant liquidity pull? If the answer is yes, then I go to the second question. If the answer is no, I just stop there and I don't touch anything and I'm not looking for any market structure shifts. The second thing is, once we have marked the lows and the highs that have created the latest higher highs or lower lows, depending if we're in a bullish or a bearish market, is this major swing point that we have marked broken? And how did it break? If it's broken, how did it break? Did it break with displacement or no displacement, and do we have a full body closure below this swing point, or we have just a long wick and price closed within the same range? The reason why I'm looking for these things is because I have seen that when price is breaking with displacement, this is the best confirmation that we have a structure shift. And when there is no displacement, I'm paying closer attention and I'm more observant of what price is telling to me. If the body of the candle, let's say if we are looking for a confirmation on 15-minute chart, if the body of the candle closed below this swing point or not. So if we close with the full body, there are higher chances that we have a solid market structure shift. And if we only broke with a wick and price came back in the same range, in this case, this is a lower probability market structure shift. And the third thing is, let's say if we have a long wick or no displacement, the third question that I ask myself is there a fair value gap below this low? So do we have a fair value gap below the low or above the high that was broken? If yes, then I would wait for a clear order flow shift or another break for price to confirm to me that we are shifting the direction. And if there is no fair value gap, which might act as support or resistance, then we're good to go to look for an opportunity based on our entry model. So let me just show you an example of this. So now I'm gonna first give an example of a valid market structure shift, and later I'll give an example of a liquidity grab. So the first question, did we tap into an area of interest on a higher time frame, or did we take a significant liquidity pull? Here, I mentioned that on the weekly chart we had the first market structure break here, or market structure shift, and we had another break of structure here, so we created a new higher high. So did we tap into an area of interest on a higher time frame? What is an area of interest? When we are in a bullish market, an area of interest is an order block or a fair value gap that is in discount. Did we tap? Yes. Once the answer is yes to this question, then we go to the second point. The second point is mark the last low or high that created the latest higher high or lower low, depending on the structure. So in this case, we were bearish. So what is the last high that created the lower low? It was this one that created the lower low. So this is the high, and we had the break over here. How did it break? We broke with a full body, which is a solid confirmation that this break was valid. And the last question, is there a fair value gap below the low or above the high? In this case, I wouldn't ask myself this question because we had a solid break and we are at a good point of interest on a higher time frame. But let's say if we had just a week and then price coming back into this range, in this case, yes, I would have asked myself, and since we see that we have fair value gaps here, I would have waited for additional confirmation. So this is the valid market structure shift. Now let's look at a liquidity graph example. So here is an example of a liquidity graph. The first question, did we tap into an area of interest on a higher time frame? And did we take a significant liquidity pull? In this case, we can say yes. I know that the market structure shift occurred here, so we shifted bullish. But the overall structure on a higher time frame, we can consider this move as one expansion leg. So we can say yes to the first question and go to the second point that I mentioned. So in this case, which was the low that created the latest high? It was this one here. Is it broken? Yes, it is broken. But how did it break? Did it break with displacement or with a full body candle, which is the higher confirmation? In this case, the answer is no. We didn't have displacement and we just had a long wick that liquidated this low and came back in the same range. This is telling to me that, hey, be careful, this is most probably just a liquidity grab. In this case, is there a fair value gap below this low? No, there is no. But since the body of the candle closed within the same range, I wouldn't even go to the third question in this case. So we had a long wick. When we don't have displacement, then I can ask myself if there is a fair value gap. But when we have just a long wick closing, in this case, I would rather stay away and wait for more confirmation. So in other words, you have to identify the idea on the higher time frame and understand what is happening on the higher time frame, then drop to the lower time frames and look for valid points and confirmations. And if you have good understanding of them, you're going to be able to identify the difference between a market structure shift and a liquidity grab. Most common mistake with a liquidity grab is people not knowing how to identify the major swing points. If you know how to identify the major swing points and wait for a solid break of the major swing points, I believe that your win rate will increase. If you're still watching, it means you liked the video and found it valuable. So don't forget to leave a like, comment, and subscribe if you haven't already. Thank you so much for watching. I appreciate all of your support. Trade safe, and I'll see you soon again.